Yeah, I think the biggest piece is understanding investor expectations. It's something that brands just don't have any insight into because you're not dealing with investors. So I wouldn't expect you to understand, understand what investors are thinking.
Welcome back to the Commerce Collective podcast brought to you by Flywheel. I am your host, Emma Irwin, and today we have a special guest who is going to cover the retail and e-commerce industry from a different perspective than what we're maybe used to on this podcast. So obviously, it's going to be so good and you're going to learn something new, guaranteed. We're talking all about the importance of actually understanding retailer financials as a brand and even an agency, all from the perspective of the incredible Edgewater research team. Without further ado, let's meet our guest.
Eamon Kelly actually grew up in Chicago, went to John Carroll, which is based in Cleveland, got started in the industry actually after my sophomore year of college, had an internship. A surprising fact, actually interviewed only one place and accepted the job there. It was at a company called Midwest Research, worked there for about 5 years. A bunch of people had left to start Cleveland Research, worked there from 2006 to 2018. And then in June of 2018, there was six of us that had left, 7 of us that founded Edgewater Research. And we've been around since 2018. Again, started with 7 of us and up to about 18 of us as of this month.
So Edgewater Research, in case I'm going to guess everyone listening to this podcast has heard of Edgewater Research. If they haven't, what are they doing? But can you tell me a little bit more about Edgewater Research and the research that you guys conduct?
Sure. Yeah, we're a stock research company. We focus on a lot of the publicly traded retailers. We have 3 components of our company. We have a tech team, digital social advertising team that overlaps a lot with what Flywheel does, the likes of Facebook, Snapchat, Twitter, Pinterest. And that dovetails into our consumer team where I sit focusing on the likes of Amazon, Walmart, Target. We sell our reports to a lot of the investment community, all the major hedge funds and mutual funds looking to invest in the various retailers. And then, we also provide that research back to a lot of the brands, and agencies in the industry looking for a better understanding of what's happening out there in the marketplace. The big thing that makes us different from a lot of firms is, we're pretty small. I think I had mentioned earlier, we have 18 people. The vast majority of us that started the company have been in the business for about 20 plus years. Really talking to a lot of people in the industry is different from a lot of these New York competitors of ours that do a lot more on the financial side than we do. But that's probably the biggest difference between us and some of our New York-based competitors.
I see. And I read a ton of your reports. Flywheel is very deep in the weeds in many of your reports, but the amount of information that you guys are able to source is quite incredible. You don't have to reveal your sources, but how do you get so much information? It's like you guys are within the companies themselves that you report on.
Yeah, I think a lot of it's just relationships that we've built over the last from my colleague Devin, who's been with us for a few years, to again myself and a couple other people on our consumer team doing it for close to 20 years. It's just relationships over those years, dealing with various people at various brands. As you can imagine, a lot of people move on, and your network kind of spiders out over the years as people move on into different industries, different companies. So that's really the biggest part of it, is just networking, engaging, and really making sure that not only are we getting value from people that we talk to, but making sure we're providing value back to everybody in the industry as well.
I see. Yeah, a lot of the reports, I'm like, it's like they work at these companies. Dang, it's like they're on the finance teams there, literally writing the earnings reports. All right, fun question for you before we start getting into the weeds. What is the last thing that you purchased online?
Last thing I bought online was actually Icebreaker's gum.
Heck yeah.
Super odd. But
what flavor?
Yeah, it was grape.
Peculiar flavor choice. Okay, I see. I was really expecting mint, and then you said grape. I was like, huh.
If you would have asked it a week ago, it would have been mint, but
okay.
it was grape this week.
Icebreaker's gum. Heck yeah. Where'd you buy it from?
Amazon.
Okay. Now that you've got a bit of background on Edgewater and you now know that Eamon bought grape Icebreaker gum on Amazon as his most recent purchase, let's get into this episode. We are first going to cover the basics of understanding retailer financials, and then we'll get into the actual importance of understanding these financials as a brand or agency, because hey, these financials determine a lot of what you see in terms of retailer motivations on a quarterly basis. So first up, I asked Eamon to tell me about what the most important elements of a retailer financial report are for non-investors, aka those of us in the retail industry making the pieces of the puzzle fit together, making the gears turn, you know what I mean.
It's really simple of even how a lot of the brands look at their P&Ls. I mean, it's really sales comps. I mean, Amazon doesn't have comps, but a lot of the retailers have same store sales. So, starts with there, and then kind of bleeds down to, cost of goods sold / gross margin, expenses, earnings from a very simplistic standpoint. I can go into a little bit later, but there's, so many other metrics that we look at from inventory, advertising growth, e-commerce growth, net customer ads, depending on the retailer. There's so many different metrics that matter, and a lot of them matter at different times too, right? One quarter, the focus might be on sales. The next quarter, it might be focused on gross margin. So it really depends on the various retailers, but from a simplistic standpoint, it's really how a lot of the brands look at their P&L. I mean, those are probably the sales, margin, and expenses are probably the three biggest components of what we look at from a financial perspective.
Sales, margins, expenses. Got it. I don't know much in this world, but I do know that, earnings are important because they drive share prices for investors. And because we work with the majority of large retailers, can you tell me about what elements actually drive share prices for the major retailers? Because I have no idea.
Yeah, again, I think it really varies by quarter. I think, obviously the biggest one is the sales aspect, is the margin aspect, and is the earnings flow through aspect. But, there's some other components, like I mentioned, the big thing you guys focus on here, advertising, right? As a lot of these retailers are building out their retail media networks, that's become probably one of the biggest focal points from a lot of the investment community. And, I think as investors are focused on, advertising, it's forcing a lot of the retailers to focus on advertising. In many instances, it's incremental. In other instances, it's not. I think in some of the instances, it's not incremental. And I don't think a lot of the retailers even care because they just want to show that advertising's growing. Investors see that advertising's growing and they think there'll be a flow through, later down the road. I think of one retailer like Chewy, for instance, is a big one lately. They have a long-term growth target or medium-term growth target of getting advertising to be 1% to 3%. It's a little under 1% today. How much of that is incremental? A chunk of that is probably incremental today to go from, call it 0.5% to today to getting to 2% to 3%. I'm not sure how much of that will be incremental. I think, a lot of brands it's not going to be incremental, but, the investors, I think a lot of the retailers are trying to pull one over some of the investors' eyes in terms of just showing the advertising's growing, even though it might be just coming out of co-op or, some slush fund that they use as well. So, that's a big one. I think some of the other ones, if I look at like, Amazon or some of the e-commerce retailers, it's, the FC investment. How are they optimizing that? Their ability to leverage, all the investments that they've made over time. It was something, Amazon's been investing in the network forever and really hasn't started to leverage that until the last 12 to 18 months. So there's many things like that. And I'd say the last piece for somebody like a Walmart or Amazon is the 3P seller fees. It's something that's been a big earnings driver for both of those companies. And I think, as you probably see increased marketplaces opening up from some of these other retailers, is probably going to be a big driver for a lot of the other retailers as well.
On that thought, I think brands and agencies look at retailer businesses differently than investors do. At least I would probably hope that they do. But I don't actually know in what way. Can you kind of elaborate on that and how they're looking at things differently?
Yeah, I think the biggest piece is understanding investor expectations. It's something that brands just don't have any insight into because you're not dealing with investors. So I wouldn't expect you to understand what investors are thinking. I'd tell you today, we just hopped off a Dick's Sporting Goods earnings call, had a pretty good quarter. Sales were better. Margins were better. If you gave me the press release, I probably would have told you the stock was going to be up. Before I came in here, look, the stock's down 8%. Go figure. there's lots of different things. Another example, I got a call a couple weeks ago from somebody following Best Buy's earnings call, and it was pretty ugly. It was bad. The stock was up 10%, and so a brand called me and said, I don't understand what investors are looking at. Like, this was the worst earnings release I've ever seen, and the stock's up 10%. It's all just about expectations. I think a lot of people in that case, they expected things to be soft. A lot of times they're looking at what a lot of brands report, what a lot of the competitors are reporting, and they can get a sense throughout the quarter whether things are going to come in a little better or a little bit worse. So, I think that's probably the biggest piece, is just understanding that investor expectation piece. And then, I think some of the other pieces is, something like Amazon with AWS, that's a piece that was, slowing a lot more for a while, was slowing for 12 to 18 months. And at the same time, you had a lot of the retail profitability improving. I think that's just a piece where, a lot of the brands aren't looking at something like AWS. We get a lot of questions for years around, Amazon. And whenever we talk about AWS, if we're presenting at something, I look around the room and kind of everybody's falling asleep and not paying attention. But, I think in many cases, it's important for brands to understand their customers' entire business, not just their small niche piece of the business that they're dealing with.
Got it. I'm curious because of, you mentioned like 20 plus years in the business and researching these things. Who are, in terms of major retailers, who are the winners in your opinion? Unfortunately, we can't talk about really the losers on this public facing podcast because they're my friends. But who are the winners and why currently?
The losers are pretty simple. They're probably not around any longer. So that's true. That's an easy one.
Easy out.
I'd say the winners are the two that come to mind are probably Walmart and Amazon. Especially you look no further than, the last several months as the macro seems a little bit softer. You see a lot of trip consolidation. I'd say the other one, we don't track Costco, but, they seem to be doing a great job of continuing to win share. So, as you look at trip consolidation and kind of one-stop shops for all, categories, those are probably the three specific retailers that come to mind. For me, that have had success. They've all had their issues over the better part of the last 15 to 20 years, but by and large, maybe a year here or there thrown out the window, they've kind of succeeded and outperformed most of their competition.
Got it. I have a kind of a predictions question. Like, take it 10 years down the road in the Amazon, Walmart kind of competition. Who do you see one of them kind of really winning over the other 10 years from now?
It's a tough one. If I was asked that 10 years ago, I always got questions of, should I invest on Amazon? And the easy answer for me years ago was like, it was kind of a no-brainer. They're kind of taking over the world. Whether or not the stock's going to be up or down 10% in the next month, year is irrelevant. But, as we look, they're going to continue to win share. As I look today, I think it's kind of the same way. Between those two, I don't know. It's a really tough one. I think they kind of both have their flaws. I think, Walmart's done a much better job of building out delivery. They have the stores that they can leverage throughout the country. Amazon's obviously done a much better job with delivery and speed. I don't know that I see Walmart necessarily catching up. I don't know that they necessarily should try to catch up. Again, they're leveraging their store base, Amazon leveraging delivery. Probably a nice mix for the two of them to be kind of the number one and number two 10 years down the road. That
makes sense. If I were to put money on it, I'd be like, it's probably kind of similar to 10 years down the line in which they're still around and they're killing it.
Yeah, it's a coin toss. There's, again, so many different things that can go right or wrong. We've seen Amazon probably have more successes and also have probably had more failures with stuff, right? So you probably see that over the next 10 years, still probably more successes and more failures out of them, whereas Walmart's probably a little bit more steady Eddie.
We've got an understanding of those key elements of retailer financial reporting. We've got some predictions on who is going to continue to thrive in retail for the foreseeable future. And now it's time to dig a bit deeper into how these earnings reports impact what we actually see happening on the ground when we're working with retailers as a brand. I asked Eamon to tell me more about how what might seem like simple, unimportant info in an earnings report might actually prove to be something chock full of information on how a retailer might behave the next quarter.
I think the last couple quarters with Amazon is the perfect example, and then probably a Wayfair example as well. But I think if you look at Amazon, the AWS business had been under pressure, like I'd mentioned, for a few quarters. I think that what what that caused was a lot more focus by Amazon, seeing some of the downturn on AWS, forced them to kind of crank up and, pivot to focus more on profitability and again, go after that asset utilization and driving that with brands, cranking up some of the funding asks and pressure on brands over the last few quarters as they saw the pressure on the AWS side. I think it's interesting now in the last quarter where you have, AWS, seems to have turned a bit of a corner. The outlook was a lot more optimistic, more positive. I think that was probably the biggest fear for a lot of investors was AWS continuing to downtick. I think finally seeing that improve, really, caught investors, I don't know about by surprise, but gave them a bit more confidence. And, I think that's been one of the bigger drivers to what, has driven the stock here the last few months. But, I'd say that's how quickly things can turn, right? I mean, it only took a quarter or two for that business to slow down, and it took a quarter or two for that business to turn back the other way and accelerate. But, you had several quarters of good sales on the retail side. Now last quarter, seemed to be a little bit more squishy. Sales seem to be softening a little bit, but, the AWS business improving certainly has given investors a little bit more confidence. So, it kind of took their eye off of the retail business slowing as you've gotten that reacceleration. If both of those had remained soft, then they probably be struggling a little bit more and facing some more challenges.
Yeah. And I think of with Amazon's retail business and missing kind of profit marks and whatnot, that then trickles down to a brand as well, because you might find Amazon asking for more accruals, more investment from your brand in terms of media on the site, etc.
For sure.
And it all just kind of trickles its way down. Even if you want to ignore a long earnings report, there's a lot in there that really gives you insight into what you can expect from Amazon.
Yeah, and I think the other example I'd give is Wayfair. If you remember back to when container costs began to spike, that was one where we had heard from a lot of the manufacturers in that industry. You think about what Wayfair sells, it's big, bulky, heavy furniture, right? You fit 100 sofas in a container. And so, as we looked there, they were the first one to feel that pressure because not only are their items heavy and bulky, they actually don't own any of their inventory as well. So when the costs went up, they felt that first more so than anybody. So, that was a big thing that investors had a lot of focus on then. And I'd say even over these last couple quarters, as there's, some ups and downs with container costs, the focus has reshifted there again on, some of the risks with the Red Sea and containers going back up. Thankfully they've come down a little bit, here over the last couple months, but it's kind of small things like that. You might not even think shipping, but that was by far the biggest thing investors were focused on, with Wayfair there for a while was just the container costs and where those were going.
Yeah, it's crazy how everything is so connected. And I'm also thinking about how I believe Walmart's last quarter was really good and really great for Walmart and how that can trickle down to a brand as well. And it's hey, maybe you're going to see more innovation coming out of the different areas of Walmart because they hit their marks and they did better than expected.
Yeah, I would say the one thing is let's not kid ourselves. When these retailers put up good earnings, it doesn't mean you're getting a break as a brand. They're going to continue to pressure you. So
hey, I like the discourse. It's a good point. Before we could wrap up, I asked Eamon to tell me a bit more about research that Edgewater conducts beyond retailer earnings breakdowns, which, by the way, I highly recommend their earnings report summaries, which very nicely bullet out all of the need-to-know points of an earnings report so that you don't get lost in the sauce of numbers and words like I do. But anyways, we're talking about research outside of this, just so that you know what all Edgewater is capable of.
Yeah, I mean, I think a lot of the brands, it's, what we focus on is really what brands care about, right? What's happening with sales? Are things getting better? Are things getting worse? Trying to put that in perspective across the various categories for the brands to put in perspective. I think a lot of people, everybody out there probably talks to their friends, talks to people in the industry to get an understanding. We're talking to hundreds of manufacturers on a monthly basis. So, really can kind of tie the knots, not only for a specific retailer, but across all of retail, not only across all of retail, but across retail, across digital advertising. It ties that knot with what's happening. I think a lot of the things are really, a lot of what goes into our reports are really learning off of the brands what questions they're trying to figure out, right? I might come in to a conversation with a brand with 3 or 4 questions. I go into the next call with 8 questions because people have, issues that they're dealing with. It's really trying to help brands learn from other people's mistakes and vice versa, right? If, people make a mistake, like what would you have done differently with that retailer? How would you correct that? What advice do you have for other brands out there? So, it's really trying to tie the knot of what is happening with all the brands and across all the industries to figure out, at the end of the day, what's happening from a macro perspective. And to your question earlier, what retailers are winning, what retailers are losing, and really the why behind everything, right? Like that's the biggest piece that we try to dive into. Is it's great to hear that sales are better or worse, but the bigger question is like why, to try to figure out that sustainability, whether or not that's something that can continue on for the next quarter or two, or is that something that can continue on for the next couple of years.
That makes sense. All right. With that, I'm going to ask you for any kind of closing thoughts, anything really wild and pressing that you haven't said yet that you want the world to know.
I'd say the biggest thing, and this has come up in a lot of, anybody that I've talked to over the last couple of weeks, I'd say the biggest piece that I've tried to hone into a lot of brands lately is I think it's really important for brands to understand where retailers are focused. I think the vast majority of the retailers recently have been a lot more focused on profitability. Again, that's where investors are focused. That's where the retailers are focused. They can all control profitability a lot easier than they can top line. And as a lot of the retailers are focused on profitability, brands for the most part have been a little bit disappointed this year in top line growth with a lot of the retailers. What I'm finding is a lot of the brands, if top line's softer, what do? You turn up the spigot on promotions, you turn up the spigot on advertising. And I think the challenge that we see right now is in many cases, at least from a promotion standpoint, we're seeing more and more like it's not driving incremental demand. It's really just becoming an incremental cost of doing business for a lot of these brands. And I think you're starting to see some of them pivot to focus on profitability. And I think, the challenge is if your retailer's focused on profitability, you're focused on top line. The retailer's not focused on on top line. Like what are they actually doing to bring more eyeballs to the site, to the store, to draw customers, into those retail doors? I think that's the biggest challenge. And it's the biggest thing that I see, a lot of the brands starting to pivot to get a little bit more in lockstep with what their customers are doing.
And with that, we've made it to Eamon's digital wish list. Sort of.
I don't think I have anything that's
nothing in your digital wish list
in a cart. No, usually it doesn't go in there unless I actually need it or want it.
Oh, you have much more restraint.
Am I solo on this one?
Yeah. Yeah. I have like 40 tabs open currently of things that I just want that I won't purchase because they cost money. But interesting. Okay. Sometimes they'll be like, well, I'll accept a house. I'm like, well, that good. Me too. Thanks. All right. In that case, that wraps us up. Thank you so much for doing this and taking the time.
Thanks, Emma. It was great chatting with you.
Nothing on the digital wish list. That's actually crazy. That is a life that I don't know. On that note, we've made it to the end of this episode of the Commerce Collective podcast. Thank you to Eamon and Edgewater for the time. As always, I have been your host, Emma Irwin, and I will see you next time.